the membership executive at Social Enterprise UK. So this workshop webinar is sort of brought to you in partnership with Good Finance and SUK. I've got Elaine here as well, who's the head of membership. And I will keep this quite short. Do you want to quite quickly say hello, Elaine?
Hi, everybody. Thanks for joining us today, and I hope you all have a good webinar.
Absolutely. Just quickly, I know lots of you probably heard of us already. Just wanted to quickly mention that we are a membership body, and if you haven't already joined us, please do. We do great events like these. We have a great thriving online community, and we are the largest network of social enterprises in the country. I'm going to put a link in the chat and an email in the chat, so do please feel free to get in touch if you have any questions. And I'll hand back to you, Mel.
Lovely. Thank you, Chris. As I said, if anybody wasn't here, we are going to record this session. We had quite a lot of people signed up, and as always, some people can't make it, so we want to make sure that we capture the content so that it can be replayed or shown to anybody else. So, again, if I missed you before, my name is Mel Mills, and I'm head of social engagement at Big Society Capital. Myself and the team run a lot of these types of events so that we can try and help social enterprise and charities understand more about how and when social investment can play a part. I'm really delighted that joining me today, not least so that I don't have to do all of the talking. I have three speakers with us today. I have James Ridley, who's Director and Company Secretary at Wolverton Community Energy. I have Martin Landers, who's the Chair of Tees Valley Community Asset Preservation Trust. And we have Dan McCallum, who's Managing Director of Any Co-op. And what we really wanted to do in all of our sessions is to bring 3 live case studies from peers who've raised investment. And in this energy resilience, Let's Talk Good Finance, we're going to try and give you 3 different types of case studies. So from organisations who've raised investment to actually deliver and to collect energy and distribute energy, from organisations who help and support others with energy efficiency, and then an organisation who's directly raised investment for their own use in terms of energy resilience. So I'm going to try and cover those 3 different scenarios. But the way that we usually start is just to try and find out. Now, I'm conscious that in this lovely mix of people, I have quite a few social investors that are well known to me. So I'm thinking that when we do this next Mentimeter exercise, which is designed to test your understanding of social investment, I'm probably bearing in mind the weighting we have at the moment. I'm going to ask the social investors not to respond. Otherwise, I think we're going to have an awful lot of experts, and that might just tip the balance slightly outside of our normal Mentimeter. So Olivia has just posted the Mentimeter in the chat. And what we always ask our audience that Let's Talk Good Finance. So this is for you if you are a social enterprise or charity, you're an organisation who doesn't specialise in social investment. And what we're just asking you to do at this moment in time, where would you rate your own knowledge of social investment between 1 with no knowledge, pending excellent knowledge? I can give you, after we've done this, I'll give you a little bit of an indicator of what this score tends to come out as when we run these events across the country. So I think we've just got quite a small number of people, but if we can get you to respond, that would be great. Maybe the team at SUK, maybe you want to do that as well, depending on how much you think your knowledge is. And if you can just give us a little score, that would be great. If you help other organisations, that's also fine. I've got Neil on the line, so please do feel free to pop in your understanding. Probably about where we'll stop. So 5.6. Actually, a little bit higher than our normal average. Our normal average is somewhere around the sort of 4 number when we do this event. So what we're going to aim to do is we hope that by the end of this this session that we're going to help that number to improve. We're definitely not planning to be able to get anybody to be an expert in time, but hopefully we can to build on that. Okay, so the next thing that we like to do, and this is more for my benefit than anybody else's, and also for our speakers, is just to check that we're going to give you what you want. We're always conscious that your time is precious. So we are keen to know what you're hoping to gain from today's session. Now, anybody can answer this. So please feel free to just type in a couple of things, whether you've got a specific specific reason for coming today, and there's something specifically you want to find out, whether it's just general information, whether it is about helping others in your network, or whether you've heard about the Energy Resilience Fund or other investment initiatives, and you're hoping to find out about something specific. It would be great if you can let us know why you've come today. Hopefully, a couple of minutes. So it's a broaden knowledge. Brilliant. I'm really happy to freehand draw. Interesting. General information. Great. Okay. Okay. Yes, it is definitely a topic, I suppose, particularly around the cost of living. What funding is available to help lower energy bills for social enterprises? Yeah. And learn more about how social investment can help energy resilience. Well, I'm definitely hoping that we do from that, and also by hearing from peers. And real examples, I love that one. That's particularly important because we're going to give you a range of other case studies as well. And there are more examples. We've got lots of social investors participating today, and I'm sure they'll be able to chip in some more case studies that we don't cover today. Okay, lovely. Thank you. Right, so we're going to do what we normally do when we do any Let's Talk with Finance. So we're not going to assume, because we know what they say about assumption being the enemy of understanding. So we're going to start with a very brief introduction to what is social investment, and hopefully we can just put into context what our speakers are then going to cover later on. So I have a few quick slides. Hopefully not going to take too long to go through this, because I know you want to get to the best bit, which is hearing from Jade, Martin and Dan, who you can see on the slide in front of us. Okay, so let's just talk about what the role of social investment is, and what it is. Social enterprises and charities, I probably don't have to say this, are dealing with some of the most challenging issues in the UK. So the good news is that social investment works all across the UK and on a range of different social issues. But let's get the elephant in the room out on the table. Hope the table is strong. Social investment is the use of repayable finance to help an organisation achieve its social purpose. What does that mean? It basically means it's money that you borrow and usually have to repay with interest. This is different to grant, and it comes with a whole range of different pros and cons, which we're going to try and cover today. Okay, so how does social investment work? So you need to be trading, or to have an idea around trading or generating revenue or income. Charities and social enterprises will need to generate a surplus. I'm not keen on surplus, actually. I'm just happy to say profit is what we do with the money that makes us different through trading activities. But also don't forget things like contracts and grants and donations, and a combination usually of all or some of these is quite normal for social enterprise and charity models, business models. So repayment, as I said, you need to be trading and have some income generation, or to at least have an idea on how to do this, because it is the profit or surplus from that that is then used to repay investors. And the thing that we always talk about is that social investment, and this is probably one of the things I want you to take away from today, that social investment is not an end in its own right. It is simply another tool in your financial toolkit that sits alongside donations, grants, and other forms of income. And it's probably about understanding when social investment is the right tool. Now, I can spend a lot of time trying to tell you what social investment is, but we have this lovely 1 minute, 34-second animation that can do the job much better.
Across the UK, charities and social enterprises like yours are tackling some of society's biggest problems. Maybe you've set up a coffee business to give people the skills to get back into work, or are running a nursery and using the profits to support local parents. Whatever your mission, you'll need money to help with cash flow, to grow your organisation, or to buy an asset like a new building. You might even need finance to kick-start your new venture. And that money could come from traditional grants or donations, or as a loan from your local bank. One option is to get that money from a social investor. That social investor could be an organisation or an individual, and you can borrow their money or offer them shares in your organisation. But what makes a social investor different? Well, they don't just want to see a return on their investment. They want to see their money being used for good, helping you to keep delivering your social mission. Sound good? To see if it's right for you, check out goodfinance.org.uk.
Okay, lovely. If you ever need to go back and rewatch that animation, or if you want to show it to somebody else that wasn't able to be here, you can always find that on the finance website, right on the homepage. So I started to talk about your financial toolkit, and I thought it would just be useful to go back to these range of tools. So on the left-hand side, we have trading, which might be with other social enterprises and charities. It might be with businesses. It might be directly with consumers, but it's essentially the enterprise activity that you carry on. You may also have donations or fundraising that might actually be part of your business model. And we know that lots of social enterprises and charities end up delivering contracts for central government or local government or third-party contractors. And this may or may not be based on a payment by results model. Now, in terms of when social investment is the right tool, it's certainly not the only tool. You may already bank with a mainstream investor, or you may be able to get money from a bank or even a social bank. You might need to look at social investment from a range of different investors, including social banks. And I'm going to talk a little bit about who the social investors are. And of course, grants. We're never going to say that grants are a bad thing. After all, that there are maybe parts of your organisation or your business where there isn't a revenue stream. You might need to target grants to that particular support for impact and to support the communities that you work with. It's probably fair to say that you may use a combination of these tools depending on your circumstances. So understanding when, I like this analogy, when to use a hammer and when to use a spanner is probably what we're trying to help you do. Okay, so key considerations. If you are going to look at social investment, these are three things that you really need to consider. So the purpose, number one, what do you need the money for? Very interestingly, we have a tool, which I'm going to talk a little bit more about on Good Finance, and we recently analysed 6,000 organisations that had indicated whether they knew what they needed their money for, and it was very highly weighted. It was well over 75%. So we usually say that you could consider taking social investment for four main purposes. You might want to buy an asset, so that could be a building or something else that a purchase could be secured upon, a bit like a mortgage, I suppose. You might want to maintain cash flow, particularly if you're doing something like a payment by results or a local authority contract where you need to put the work in up front, and you might not get paid till later on, so you need some upfront investment to manage and smooth your cash flow. You may need to kickstart your business. So you notice that I haven't said start up here. I'm not going to tell you that social investment can never be used to start up, but it's definitely more difficult. And often this is where grant works really well to be able to do the proof of concept to show that there is a market for your business model. So kickstarting your business is often the way to get beyond that and improve your model. And then growth and innovation. So this could be actually just scaling what you do in more places or in more volume, or it could be to change or develop a new service. So repayment, going back to that, I'm going to keep talking about the fact you do have to repay this money. Is there an income stream with surplus or profit? And it could be from a range of these things, including government contracts. It could be rental income. For instance, if you're somebody that has a community building and you rent out for event space or for serviced office space, or if you're a landlord. It could be from membership fees, I suppose, a bit like the SE UK model or many other organisations. It could be from consultancy fees. And it also could be from donations or a range of different trading. So I sometimes get asked, could you use social investment actually to scale the sort of fundraising activity? Yes, that certainly has been done. The extent to which a social investor is able to take those things into account as trading income will be definitely part of the due diligence process when you're explaining to them how you actually make it. And then I suppose this goes to a bit about what makes a social investor social. So a social investor will want to know what social impact you create. Very simply put, what difference will the money make that they lend you? They want to know a little bit about the activities that you're planning to do and the outcomes, who's going to benefit, how you're planning to measure and report it, and how that impact is going to be sustainable. I suppose one of the key things to understand here is the fact that probably what's a little bit different to when you take on grant is that a social investor isn't going to tell you what you should measure. It should be something that you're able to articulate. And there will be a balance between stories and also data, and that's definitely something that you need to be able to articulate. Another nice fun fact that's here, because I think, and fun enough, I was in a different event yesterday and this came up, just to bust any myths that social investors are making money or lots of money out of social enterprises and charities. You perhaps need to, or I'll be interested to know that 85% of social investors listed on Good Finance are actually social enterprises or charities themselves. And so creating social impact is actually at the core of their mission. So this is when we start to get a little bit beyond. If you can get organisations to understand and to think that borrowing money might be something that's right for their organisation, what tends to happen with all passionate social entrepreneurs, and I've run a social enterprise myself, so I know and feel this, we often want to get from A, okay, I've got an idea, I'm probably going to need to borrow some money to do this, to Z, show me the investor. Well, actually, there's a bit in the middle, which is that, first of all, not all social investors do the same things. And also, in fact, there are a range of different ways, products, financial products that you can borrow. It's often very useful for you to consider what's the best way for you to borrow money. Then that helps you shape what social investor is best for you to go and approach or to speak to. But there are two main kinds of social investment that's available. So debt or loans is how you would probably hear this about. This is when an organisation borrows money and pays it back, usually with interest over a period of time. Or equity, or sometimes we hear this as shares. So this is when an organisation sells shares to an investor so they effectively own a percentage of their organisation. Now, the challenge, I suppose, with equity is there are quite a few social enterprise or charity models that don't allow for shares to be issued. But if you are a community interest company limited by share, if you are a community benefit society or a registered society, then this may be a tool that's available to you. We have a great couple of pages. One of the most accessed resources on Good Finance is all around governance structures and how they actually apply to social investment. And I know when I first came to the social enterprise space, the fact that there were 9 different legal structures that could constitute social enterprise or charities blew my mind at the time. So it's a really handy go-to sheet if ever you need to check. But perhaps one of the team will post that in the chat. And there are 2 main ways of getting social investment. So it can be from an organisation, such as a specialist social investment firm or a social investment fund manager. Could be from a social bank, and it also could be from a trust or foundation. So there are now a number of trust or foundations that, as well as making grants, also make repairable finance or social investment loans. You could also borrow from an individual. I think that should say angel investors. I think that's a bit of a typo. Apologies for that. And you can also do for crowdfunding and community shares. Sorry, we'll update that on the slides that we send across, because that's definitely a repetition. Who are the funders? Well, there are over 150 different social investors or social investment funds listed on Good Finance, but you won't find them on a high street. And they, as I say, range from trusted foundations to fund managers to individual investors. But how I usually explain this is along a continuum of investment and also what investors are looking for. Or more simply put, the way that I usually explain it is using one side of a monopoly board. So if at the far left you have grant-making trusts and foundations whose money is philanthropic at source, so it doesn't have to really be returned, there's obviously a strong requirement for social return. On the far right-hand side, if we're talking about mainstream or traditional investment, then clearly a financial return is the overall consideration. And social investment therefore sits somewhere in the middle of those 2 things. And we often end up talking about the cost of capital and why money costs what it does to borrow it. And that will be very much dependent on where the money came from originally. So if, for instance, you are borrowing money from charity banks, who essentially lend a lot of other social enterprise and charity deposits, they will be essentially able to take less risk than maybe if you're borrowing from a trust and foundation, or say somebody like Cat Venturesome, where their money is more source. So it's often really important for you to understand what kind of risk can be taken by the investor, because that definitely informs the cost of capital. Again, we're going to talk a little bit more about some resources you can use. Okay, so here are those additional resources. I talked about 6,000 organisations who've completed the Is It Right for Us tool. Essentially, that's a diagnostic. It takes about 5 minutes for you to complete. It'll help you decide whether social investment is right for your organisation. If it says no, that doesn't mean no, not ever. It means maybe not now. It will help you either point you to other sources of grant funding and suggest other places that you can go for support. If social investment seems like it might be a route for you, it will help you narrow down the list of investors that might be the best ones to start with. You can also do that with the fund mapper. So you can search the fund mapper by geography, so where you are, by a particular type of how much money you want to borrow it for, or by a particular product type. You can also see how many funds are available in your particular location, which are national, which are regional. Jargon. So there's an awful lot of financial terminology that's used across the sector. You know, I remember back, I've been at Big Society Capital 8 years ago, but remember sitting in an audience of about 200 people in London, while a great speaker strode up and down the front and talked about mezzanine debt. And if I'm really honest, I had no clue what that meant at that time. I really felt that was just like another floor. I'm an ex-retailer, so for me, that would have been an additional floor in my space. So one of the things when we were starting Good Finance is that social enterprises and charities, our users told us that they didn't want us to remove the jargon or to dumb it down, but they did want us to tell us what we meant. So the jargon buster you'll find on Good Finance has a whole range of terms, and we just added actually 8 new Sharia compliant terms, so that you, if there is a piece of terminology that comes up and you want to pick it up, you can find it in the jargon buster. And if you can't find it in the jargon buster, let us know, because we should be covering it. So we're always keen to hear from you. And then the cost of capital resources, there is an animation that explains more about how the cost of capital is arrived at. It's a cost of capital calculator that you can put in how much you're wanting to borrow and the range of interest that you think that you would be able to borrow it at. So you can see what the returns might look like, the loan repayments might look like over time. There's a whole range of other resources that can help you, particularly if you're thinking about taking on investment. Okay. So that's my whistle-stop tour of what social investment is. Hopefully, if you're in that 5.7 category, that's moved the dial just a little bit. But I know the thing that is going to make this come to life a lot more, and it will bring us to the relevance of today's topic around energy resilience, is here from our 3 fantastic speakers. So I think first up, and I'll hear from the peer lineup, is Jane, who's the Director of Company Secretary, I'm following over my own words this morning, at Wolverton Community Energy. And all of our peers are going to tell us a little bit about their organisation, what they do, how they've used investment, and then when we get to the end, we're definitely going to be ready for your questions and answers. You can post those, by the way, in the chat as we go along, so we can have them ready, or you can save them up ready for us. Over to you, Jane.
Good morning, everyone. I'll just get my slides up for you. I only have a few slides, but it just helps me focus when I talk to people, and hopefully it'll give you a little bit more background too. I'm here as one of the directors of Wolverton Community Energy, and I'm going to talk you through how we began, what kind of financial support we had at the beginning, how we've developed since then, and then just a few sort of last thoughts that might trigger some thoughts your side too. And then of course I'm very happy to answer any questions that come through from anyone out there. So the first thing to say is our work began by really led by a lady called Marie Osborne, who remains the director of the business today. And she set up something called Future Wolverton in Wolverton, which is a part of Milton Keynes. And it began with children sort of what does energy mean? What does insulation mean? You know, how do we need to think differently about our homes? Lots and lots. You can see some of the amazing things that they produced here. And then open sessions on inviting installers and contractors to come to community events. And the idea behind this was to try and begin to get people interested in improving their homes and cutting energy costs and becoming more energy resilient. And the way this was supported was really bits of grants here, there, everywhere, you know, and one of the bigger ones was from the DEC funding of the Green Deal way back when. And the downside of grants is they come and then they go, and then they come and then they go, and you're constantly starting and stopping, and you're just beginning to build momentum, and then it comes crashing down again, and you have to think again about what you're going to do next. But the drive to make a difference in this area didn't ever stop, and was built into the neighbourhood plan. Many of you might have neighbourhood plans in your areas. If you don't, get one. We have found over the years that it does actually give a community legal rights that, for example, talk about planning and what should matter within planning. It's only one voice, but it's a very important voice. And if you're a community that wants to build some kind of strength, then having a voice that is legally supported matters. So I'd encourage you all to have a look at that. So there was lots of, you know, ad hoc funding, little grant schemes, neighbourhood plan development. And then what we decided to do was found Wolverton Community Energy. This was back in 2015, and it was founded by 4 directors, 3 of whom are remaining, one of whom was actually a solar installer, but then left the area, so he moved out. Other directors have come in. We are a community benefit society, which means our directors are elected every 3 years. There's a rotational election every 3 years. And the directors come from the members of the Community Benefit Society. So the vast majority of our investors actually, but also our members and our directors live very locally. So very rooted in the local area. And the directors we have currently, well, we've got a huge breadth of experience between us. Maria, of course, who led lots of these wonderful community programs, is just absolutely brilliant, very creative, you know, has the endurance of something extraordinary, and as very, very engaging, has a very lovely touch, which is fantastic when you're building community cohesion. So one of our team is very technically expert. He's an IT director and has worked in many companies over the years, and often with startups, making things happen. But also he briefly worked for Amazon, for example, so a really good breadth and range of experience. My background is much more about strategy and business development, and I started life in marketing actually, so much more of this sort of infrastructure of how a business runs and what we need to do to get ourselves started. And the lovely 4th member of our directors at the moment is Robin, and he's actually a fellow of the Open University. So his background is all about energy, renewable energy effectiveness. Does the stuff actually work? You know, if you put a heat pump in, what happens? You know, does it deliver the results you need? So he's an academic, but with a really practical bias, which is fantastic. So we have a great team, and that breadth and range of experience, and we're all very different as people in terms of our risk levels and our sort of need to plan or not plan, and you know, all of those other things. That group coming together actually makes us stronger. So we work very well together, and it's very important to have that range of skills, we have found. And when we set up the Community Benefit Society, it wasn't all about Wolverton, although that's where our roots are. Our objects actually cover Milton Keynes and the broader environment too. So we are, as far as we know, still the only community benefit society in a community energy society in Milton Keynes, and we are And that's the difference we're trying to make. So do feel free to ask me more about all of that. So if we go next to the finance, I hope all of you can see that. So we actually began trading. So what is a community energy society? So after all that grant funding that was driving us insane, we watched the community energy market grow, and it was in boom time when we set up, unfortunately, just before the bust in 2015, when Cameron pulled the feed-in tariffs. But there were lots of very successful community energy societies around us. And what the idea is you actually own, the community owns the solar PV that goes on the rooftop of various different organizations locally. And what you do is you then strike a long-term lease. In our case, it was 25-year leases. And those leases give you the rights to put the panels on the roof, in effect. And then the other legal document we struck was the people who were working all of our panels, all of our energy, community energy is around B2B. So we put panels on the roof of businesses, and the businesses underneath use our green energy. So it's cheaper and it's greener. And then we sign PPAs with those power purchase agreements, which is when the business underneath the panels says, yes, for the solar that we use from your panels, we will pay you. And we strike a deal on that rate. So they pay us per kilowatt hour, which is the way all of you will pay on your energy bills, per kilowatt hour of solar PV that they use from our solar arrays. So what that allowed us to do, it gave us the return that we could give back to any investor, and we were able to raise finance on the back of that to actually pay for the panels upfront. In the community energy world, it's the initial capital investment. It's a bit like buying a house. You need vast amounts of money in the beginning, and then you can pay it off over time because you have that long period afterwards to actually raise the revenues and trade and pay back the loans. So again, a bit like a mortgage. So, and a couple of other things to say about our trading. The rooftops we have our solar on, we've got, at this point we have 15, we've got a few more now, 15 arrays related to 330 kilowatt peak of solar PV. And the vast majority of the people who are benefiting from our energy were social enterprises, and they ranged everyone from Age UK to the Milton Keynes Play Association to Food Bank at the moment to Arts Gateway, you know, a broad range. Camp Hill, which is a wonderful organization in MK. So a broad range of different social enterprises were suddenly able to predict their energy price for the next 25 years, in effect, because part of the deal we make with them is that we actually cap those price increases. So crazy in a way, because think of the profits we could have made over the last couple of years, but actually we very deliberately didn't. We decided not to do that. So our partners, our social enterprises that we're providing energy to now have extraordinarily good energy rates, and we think that's really important. That's part of what we give back. It's you know, a way to make sure that the social enterprises can keep their energy costs under control. Okay, so how did we do that? The fantastic Big Issue Invest, we can't tell you how much we love them. They gave us a loan right back at the beginning, £257,000 loan, which is actually a pretty big loan. And although the loan officially was 7 years, they committed to us over a longer period of time. So we have since refinanced with them. And the finance interest rates were around 5 to 6% and have been during that entire period. So that was, I still remember the day today when they agreed that loan, and that made a huge difference to us. At the same time, we did also run a community share offer, and that is individuals who have an interest in ethical programs, I suppose. There's a company called Ethics. It's one of the platforms where you could invest as an individual into companies like ours if you're running a community share offer, and we raised more money through them too. So That together gave us the foundation of our business, in effect. Around that, and what that immediately does, when you have something you know is going to last for 25 years, and you've got something that's going to generate for 25 years, solar PV now can last for up to 30, 40 years, then what that allows you to do is think differently about where you can potentially get money from and how you can potentially do things differently during that time. So we have had lots of grant funding. Melanie, we're talking about the mix. The mix has been really important for us. And again, lots of different companies have supported us. And I have to say that big issue investors continue to support us through the years. So particularly as we hit COVID, you know, we weren't sure how many of our businesses would go bust. We didn't know whether people were going to keep paying us. We didn't know how we were going to survive ourselves. They were amazing. And some of the grant funding that we were able to access came through them. So I would say a social funder is so much more than the money on the table, and I cannot tell you how much we have appreciated and benefited from that. So that's why we love Big Issue Invest and always will. So what on earth have we done with all of that money? Well, this is just a sort of snapshot of some of the things that we're doing at the moment. They're all about having community-owned solar. That's the big image in the middle with all the panels, and that's the bedrock of who we are. But around that, we are trying to make sure that any profits that we do make are reinvested. We're a community benefit society, so we're a not-for-profit in our very essence of our being. And we do that through various different energy efficiency projects. For example, we gave LED lighting to one of the local primary schools. That's the picture down on below there. But we've also, for example, worked with Age UK and distributed LED light bulbs, you know, different things over the years. We've done some insulation programs. So just trying to build up our portfolio, I guess, what we know about, what we can do on behalf of the community, and how best we can make an impact. And you know, so to make sure any money that we earn and generate is reinvested and multiplied through our community to get the best benefits we can from that. And that also really matters very much to us. Now, on the right hand side is much more recent work that we have in the last 6 months launched something called Home Energy MK. Now, this is actually the basis of this, the seeds of this is from grant funding from the Milton Keynes Council. So we're really happy and delighted that they have funded us to set this up. Many different communities, you might belong to, some of them have one-stop type of retrofit support in the cities. Milton Keynes didn't have one. So Home Energy MK is the sort of pilot of what that may become and what that might look like over the next few years. So at the moment, as I say, it's grant funded. Next phase, we're going to have to think about if this is to be sustainable, what elements can we actually, you know, build some sort of return from, and that we are still no idea at the moment. We're working that through. But if I can just explain some of the things that we've done. So a lot of this is about experimenting to see what works and doesn't. So the top one, everyone be familiar with thermal imaging, especially with the energy crisis we've just had. You know, for those who needed to do something fast to try and help the energy bills, we actually bought a camera and have started offering that free of charge to the community. We'll probably have to start charging for that later, to actually understand their own homes better, to know where to sort of, you know, put those draft proofing strips or whatever. We have, in association with that, run some local community energy events. And again, literally showcasing low-cost DIY type materials to help get your home warmer. And we've stood outside shops to, you know, shout about programs such as the one like Sustainable Warmth that was briefly available before Christmas, that we wanted to make sure that if it was available, people know about it, people have heard about and are able to take advantage of it. Then the other two things, the map in the middle, we've been doing some heat loss assessments. And this is all about trying to say, no matter what sort of home you've got, if it is possible to upgrade it, and you can measure. There are ways in which you can measure how well you're doing in terms of stopping the heat loss. And we think that's really important, Milton Keynes, actually, because it's a mix of very old, well, Wolverton itself was a railway town initially and has sort of terraced solid wall Victorian homes, which we know are some of the leakiest in the country. But it also is renowned for new builds. Milton Keynes has been building new homes, you know, for decades now, constantly. But some of them, because of the regulation, are still very leaky, surprisingly leaky. So if you're going to ask the question, am I ready for a heat pump? Then what we wanted to do was give people a way to check. And so we ran the heat loss assessments, and you won't be able to see the detail on this slide at all, but basically if you've got a red bottom on one of those circles, you're way off. But if you're going green on one of those bottoms, you're pretty much there. You know, that's about, you know, maybe temper a bit more, but actually start thinking about whether or not you're ready. Because we have an absolute fervent belief that you should not put a heat pump onto a leaky home. It costs more to buy, it costs more to run, and you still got a really leaky home, which means you're still burning heat out there in the atmosphere that we shouldn't be doing, you know, if we're trying to address climate change. So that's the end of my politics, sorry about that. But then the housewarming program is actually developed by Low Carbon Oxford North in Oxford, and this is free information that gives people the basics about, you know, what do I need to know about insulation when those contractors start trying to tell me something? What are the questions I need to ask? What are the options do I have? You know, how do I know whether it's right for my house or not? And we have done a series of group sessions to share that with homeowners in Milton Keynes who come along, and group discussions, you know, share some of the information and generally try and link people who are trying to do this at the same time to give each other help and share knowledge, actually. So that's kind of the range of things that we're up to at the moment. And again, do feel free to ask me all of that. So just conscious time is cracking on. So the final things I'd say is for all of those social investors out there, to somebody like us who, and all of those social enterprises that we were describing earlier, you're often trying to fix a problem. You're often trying to make change, and there's often huge resistance. And just getting that financial support, that financial yes, can make an enormous difference on an emotional level as well as a practical level. And that emotional support underpins the persistence and resilience that you might have to just keep going despite the chaos ahead of you. But it matters because obviously it gives you endorsement and credibility too. We would never have got that Milton Keynes Council funding, that grant funding, without having our solar energy business. So it's a building block for raising stakes higher. And I know that social enterprises hate giving you money right at the beginning, but actually, if you don't get money when you start out, you can't start out often. So yes, the risks are highest, but actually, you know, Big Issue Invest took a risk on us. And I think, you know, we've delivered back to them. Hopefully they think so too. But it's still, if you're in a position like us, and I'm a director on the board of Wolverton Community Energy, but I'm also director on a different community energy society called Kaliva Community Energy. It is so hard to get to the next stage because the same philosophy of, you know, you need an asset in order for us to invest against you. If you're trying to grow the business and scale up, then you still need investment that is at risk. It's really easy for people to refinance existing assets, but getting that finance to make a step change, it's really difficult. So we would beg lenience while I have a platform to beg from. For all of those others out there, cash flow and cash flow forecasts are absolutely critical to control finances, especially in our business, because the sun shines in the summer and not so much in the winter, which makes our revenue incredibly seasonal. So we might feel rich in the summer, but boy, do we feel poor in January every year. So that cash flow is really, really important. And I would say stability comes from long-term loans. They're amazing because that allows you to buy long-term assets and gets you away from that whole charging towards the next grant, you know, hopping on that funding bus, which distracts. It causes all sorts of time in terms of filling in forms, and times in filling to get the money, and time to fill in the forms to actually, you know, do all of those follow-up reports, etc. So I would just like to finish to say it's so important, and we have had such benefit from that long-term relationship with Big Issue Invest, and we couldn't recommend them more. Okay, so I'm happy. I don't know if
Thank you, Jane. No, that's brilliant. Will, you've done, I don't think you need me next time, actually. You've done so much for me in terms of contexting, and so many of the questions that I'm sure that are going to come up later. If anybody does have any questions, Jane, we'll start typing them in the chat. We'll get them ready, but because I'm conscious of time, we're going to move straight on to our next speaker. And Martin, you're going to tell us a little bit about Tees Valley Community Asset Preservation Trust. Right, yes, I think I did. And how your work, I suppose it's been really great hearing about something that's about infrastructure, and now you're going to think a bit about actual buildings and how your work works, in a different way. So over to you.
Well, thank you. First of all, can everyone hear me okay? Excellent. Just by way of introductions, I'm Martin, the chair of Tees Valley Community Asset Preservation Trust, but I'm sitting with my colleague Lynn Paley next to me, who's my walking stick today, because she knows all about finance, and we kind of share a role on the board of trustees, and my area is kind of the front man, I suppose, as you often call me, don't you? So a bit of introduction. So we are Tees Valley Community Asset Preservation Trust, a CIO that was set up in 2015. We basically run a community centre in Middlesbrough, in a very disadvantaged area of Middlesbrough, recently featured on Panorama for antisocial behaviour and crime and things like that. But the building's beautiful, and the people up there on the whole are lovely as well. But we established ourselves in light of local authority funding cuts. Back in 2010, the government's austerity agenda meant that local authorities couldn't afford to support community centres, village halls and sports facilities anymore, and a lot of them were threatened with closure. So myself, my colleague Lynn, and a few other people got together with a view to saying, well, we'll develop a charitable entity that will step in and take over the management of those assets if the council, rather than the council, close them. So that's how we came about. There's our board structure there. We've got 6 trustees, and we employ six staff. The trustees have got a broad experience in community buildings, sports facilities, and actually Chris at the end there, he's more of a gas guy, but you need gas in community buildings, so it's useful to have experts in every field. So our business is based on the utilisation of fixed assets. Put simply, that means we sell space. Our customers are voluntary and community groups, people who deliver yoga and Pilates, community nurseries, there's wood turning groups, decoupage groups. I mean, there's no end to the things that go on in community centres. Absolutely brilliant. But we sell the space to them on an hourly rate. We're successful at what we do because we simplified some of the processes that the council made far too complicated. We have a room booking line. You can pick up the phone and call us 7 days a week. Contact us through social media if you want a space to have a children's party or to set up a new community group. And we're really good at customer service, and we've totally embraced the miracle of social media as well, which, to be quite frank, that's the main way people talk to us now. They come through social media, and our staff are fantastic at responding to customer inquiries. And importantly, we try to get along with people no matter who they are. If you want to use a community space, no matter what it is, we entertain everybody. There's a guy came to us and wanted to set up a barber's shop, so we had a little office somewhere that we converted for him. So he's now doing barbering in our local community, and we asked him if in the short term he could help people with discounted rates who were doing going for job interviews and things, and he was happy to do that because we like to do nice things as well. We've got a community nursery running in one of our annex buildings. We've got New Music Girls just moved in doing things with babies. We've got 2 community cafes. One's kind of a posh one that's a tea room, and one's your bread and your bacon sandwich type cafe, because our community centre actually is annex buildings that are spread around a lake in Middlesbrough. I just wanted to tell you about this graph. I know graphs can be a bit boring, but this one tells a really good story. It goes from 2015 to 2020. Now, 2015, this graph here shows the running costs of the building when it was run by the local authority compared with the income they generated through room hire from community activities. They were basically subsidising, you know, the building around about £90,000 a year back in 2015. So that's how local authorities run community buildings. They used to throw money at them, and there was no commercial necessity, in a way, I suppose, to deliver excellent services. So on the one hand, you might think that's great that a council will give a community building money, but sometimes it can disincentivize the staff not to work hard at meeting the needs of the local community. So we took on this building at Hemlington in 2017, and our main focus was, well, how can we generate the income that we need to cover all running costs? And that's where our expertise came in. We just basically made sure that we increased capacity. We said the building's open whenever anybody wants to use it. We adopted room hire policies that made it very simple to book a room. It was basically I think it was 13 quid an hour back then. We advertised on social media. We answered the telephone when people called us, and we embraced the social media. And lo and behold, people started to come. Lots of people want to use buildings, and what tends to happen sometimes when councillors run them, I hope there's no councillors in the audience, because sometimes they get offended by this. When councillors run facilities, they tend to not focus so much on the end user, and they make life easy for themselves sometimes. So this building, we found that it was closing at 5 and 6 p.m. in the evenings, when community buildings are the most vibrant in the evenings. When people come home from work, they want to run things then. So things started to change there. And you can see as we evolved towards 2020, we actually broke even, which was fantastic. I've left the graph at 2020 because when COVID came, it just went all crazy. But suffice to say, Hemlington Lake and Recreation Centre, which we're focusing on now, generates a small surplus every year. It meets the community's needs fantastically, and it's just a wonderful place for local people to go and use and enjoy activities that enable them to reach the full potential and enjoy a better quality of life. What I haven't said is, always be ready for surprises. What I haven't said is, what have we done by way of energy resilience? We bought solar panels through social investment. And I've got this slide here about being ready for surprises, because COVID was a surprise, but no one could have predicted what was going to happen with the Ukraine war and energy costs. We thought we got over the worst. The government stepped in. We got business support grants for COVID, but they weren't so keen to help when energy bills were trebling and then quadrupling, and it frightened the life out of us, to be quite frank. Our building I think it was costing about £6,000 or £7,000 a year in electricity, and when we were looking at the contracts for energy, they were going up 4 times. I mean, imagine the electric bill going from £6,000 to £24,000. So it scared us, and we had to start thinking about what we were going to do. I won't stay on this graph too long either, but one of the things that we've always done in our community centre is we take meter readings every week. Our volunteers and staff go and read the meters every Wednesday morning to see what we've used in electricity and gas. And the reason why we do this, actually, it was a few years ago, something went wrong in one of our buildings, and the electricity was £500 in 1 week, because no one could stop this machine that was running. So we've always checked meter readings since then, and it gives us a really good heads up on what we use per week. And in Hemlington Lake and Recreation Centre, electricity costs prior to the solar installation, which, by the way, went in about 6 weeks ago. There was a delay on the solar panels because the whole world seems to be wanting them at the moment. But prior to the solar panels going on the roof, our electricity costs in that building were £130 per week, based on a unit charge of 16p per kilowatt hour. Just to say something a little bit about that, one of the wonderful things about Lynn, who's sitting next to me, is Lynn negotiates our energy contracts. And in Hemlington Lake and Recreation Centre, we were just incredibly lucky. She sealed an energy contract with a provider just before COVID for 4 years at 16p per kilowatt hour. I don't know if anyone ever looks at your energy costs at home now, but Octopus Energy, which is the cheapest, is 32 pence. That's this morning. So it's double now. I mean, it went even crazier a few weeks back. It's starting to come back down now. So we were cushioned from the main impact of the energy costs. But our energy contract is up for renewal in September this year, and we knew we had to do something quickly because, you know, the thought of paying 4 times as much would have absolutely been catastrophic for us. So that's where we got involved in social lending, and we contacted the Key Fund and started talks around loaning money and putting the solar installation on, which we've just done. I want to talk about this graph now. This is more recent. This is the last 10 weeks meter reads. So bear in mind that the solar panels went on 5 weeks ago. This is incredible. It's a great story. The panels are doing exactly what they said on the tin. They said in the month of May, they would basically reduce your energy usage by about 50%, and it's pretty much on the nail. Instead of £130 a week, the average cost now in our building £64 a week, which is fantastic. I just want to talk about these boxes at the bottom, because people might inevitably have questions around, you know, how would you afford to repay your loan? If we're saving £65 a week, this is the third box along. That gives us a monthly saving of £260 now in May. It'll increase. We'll make more money in June and July, and hopefully in August if it's sunny, and then we'll make less money and obviously in the colder months. But on the whole, we'll be generating around about £150 to £200, £260, £270 per month. But our loan repayments are £420. So you might think, well, you're mad. You still got a lot of money to pay back each month. But that's, bearing in mind, that's based on 16p per kilowatt hour. The cheapest energy available today is double that. So we can reasonably conclude that by September, our monthly savings will double, and therefore will be around, broadly speaking, around about, we'll have the income savings that will more or less cover our loan repayments, so we'll be cost neutral. And like everybody else, we're in a recession. Our room hire prices, we've increased our room hire prices as well. So we're in a pretty good position, and we'll set aside money in the summer months to pay in the winter months, so that we'll basically be able to cover all the costs of the solar installation without it hurting us at all. So I put this slide in because I thought it was about being bold. We were petrified of social lending, social borrowing and lending. I get confused which one's which. But Lynn, my colleague, convinced us that we need to start looking at this and maybe get used to loaning money as well, because we have got a good business model. It does make money year on year. We are in a position now where we can start thinking about talking to lenders, and we did just that with the Key Fund. I think Brian Coughlin is in the audience now. He was absolutely fantastic with us, incredibly supportive, and helped us navigate our way through the complexities of finance. And that's a bit of indication here about what we've borrowed in the past as well. We first were introduced to social lending, social borrowing via the Key Fund about 3 years ago. But sorry, we applied to a funder called Mercer's, and the guy from Mercer's introduced us to the Key Fund. He saw a business model, and he basically said, look, you need to be thinking about social lending. And he introduced us to Brian Coughlin, the Key Fund, and we took out a small loan to reinvigorate the community room, put some windows in it to generate some additional income. That worked really well. We generated the extra income that we thought we would, and then when an opportunity come along to apply for the Energy Resilience Fund, it was a no-brainer for us. We applied. We successfully secured a large loan, and we've put 52 solar panels on the roof. And like I say, it was only 5 weeks ago, but it's incredibly exciting just looking at the meter reads now, and I think it was a fantastic decision, and it will turn out to be a fantastic decision for us. Or just to say a little bit about finance, the Key Fund were wonderful. We got a kind of a hybrid combination of we loaned some money and they gave us some grant funding as well to make things a little bit easier for us as well, which we're fantastically grateful for. So our key message is, don't be afraid to ask for help. We've asked for help and we got it, and it's been a wonderful story so far. And maybe in a year from now I could come back with a bigger picture. And that's me, and that's Lynn. Thank you for listening.
Lovely, thank you so much. I'm loving the dog pictures as well. I thought they were particularly effective, I have to say. Thank you so much for making that so easy to understand. And just the first job and best return, I'm going to try in there for you is borrowing money, so loan, and also some grant is often referred to as blended finance or a blended finance product. So we perhaps put that in as a jargon buster, and that's where you're getting. I suppose in many ways it's what we would see as sort of matching money, but the difference is that you're not having to run around and find somebody else to match a piece of grant. There's so much in there that was really interesting around hopefully many of you might not have thought at the beginning, sometimes you can actually borrow your money and it's going to save you money. So lots of things we're going to come back to, but swiftly let's move on to our third final last but by no means least, speaker Dan, who is going to talk to us a little bit about what his organisation Egni Co-op does, and I'm really excited to hear some more. So over to you, Dan.
Okay, thanks, Mel. Hopefully everyone can hear me okay. Yeah, I feel like I'm a sort of granddad really of the sort of like community energy movement. We started in 1998. But just a sort of a bit of background. So we're a charity, Owl Ammon Tower, which means Wind of the Ammon and Swansea Valley. And we've set up two co-ops, Owl Co-op, which is our wind farm, which is just up on the hill behind this house. And then Egni Co-op, which very similar to Jane and Wolverton, yeah, no, exactly the same, does rooftop solar. So those are separate legal entities, but they're managed by our charity. And the staff are all employed by the charity to do the sort of development work, management, fundraising, etc. We've kind of done every single kind of finance actually, partly because we've been going for so long. But our wind farm was completed in 2017, and that was funded through a £3 million share offer, and then £5 million from Triodos Bank. I would say at that stage, this was in sort of 2016, it was actually key for us that we had that a relationship with WCVA, Wales Council for Voluntary Action. So they weren't involved directly in the financing of the wind farm, but Alan Jones, who works for them in their social investment section, basically helped me a lot talking to Triodos in the same way that Jane was talking about their relationship with Big Issue Invest, kind of identifying friendly people or organizations is key. And kind of at that stage in my life, it was really important because there was a lot of risks with our wind farm at that point, trying to go through due diligence, etc. So I was sort of very grateful for Alan's kind of support and guidance at that stage, especially. We had a relationship with WCVA. We'd borrowed money, mortgage basically for our office space. So they knew us, but it was really the wind farm which has underpinned our history right back from 1998 through to the present day. On the back of the wind farm, we set up Egni Co-op, which, as I said, is very similar to what Jane has done. It's kind of bigger scale. So we've installed now on about 100 sites throughout Wales, schools, community buildings and businesses. And it's been really fast. The wind farm took us like nearly 20 years because of planning. We got turned down 3 times for planning permission, lost a public inquiry, lost a judicial review. And it was an absolute freaking nightmare. But anyway, great that it's up. The Egni massively expanded in 2 years during COVID because of the credibility that we had because of the wind farm, I think, and our history. But it shows that energy co-ops can really move at scale. Literally 5 megawatts in that period of time is a massive thing to have done. I think we're the biggest solar co-op in the UK now, rooftop solar co-op. And it's Wales, it's not the sunniest place, is it? And it's not got the biggest roofs. So it shows what can be done. And we raised £5 million from our from a community share offer. Again, going back to the same members that we had support from to raise money from the wind farm. And then also we had about £2 million from Development Bank of Wales, which was a long-term loan, but we actually refinanced that through community shares. because there's a lot more flexibility with community shares than there is with bank loans. Just some of the interesting things that the shares have enabled us to do. As part of our business model, we've donated shares to a whole range of community organisations. There's about £100,000 of shares that are owned by, things like the rugby club, football club, arts centre, etc. in our wind farm. Similarly, with Egni Co-op, we've donated £500 of shares to all of the schools where we've got panels. It doesn't make them a lot of money, but it gives them a direct understanding of the sort of business model that co-ops follow, and that's something that we want to sort of develop further, really, because like I had no clue about co-ops or shares, etc. when we first started, and it just feels like that is a good idea. We also provide free electricity to the community buildings that we've got panels on, partly because we took the view those installs are relatively small and it would be too much hassle, quite frankly, to actually try and get paid by them. So our main income actually comes from the public sector, from schools and some businesses, where our main model was charging electricity at 20% discount compared to what the site was paying. So actually, unlike Wolverton, we've done really well out of the high energy prices now. So we've actually changed our model now going forward to go back to a more fixed price per kilowatt hour rather than the 20% discount model. But it is generating a surplus for us. We've also done things then like crowdfunder, where we've gone to our members and done a public crowdfunder and then raised money for this new centre that we're developing, very similar to Teesside, sort of broad-based community regeneration type facility. I suppose we're doing more activities than Teesside are doing ourselves, and we're in a very, very deprived area. We're certainly not expecting it to make a lot of money. Hopefully it will just cover its costs, but I think fundamentally it'll be underpinned by our energy assets, by the two co-ops. Just to give you an idea, our co-op transferred about £150,000 a year into the charity, and we're hoping that Egni Co-op is going to start to be able to do the same in the next year or two. I'm sort of, we're in terms of Egni now, we're prioritizing sort of sites which have sort of got a decent roof, large roof, and are high energy consumers, because that obviously works better in terms of our energy model. We're avoiding community buildings generally because they haven't got a high on-site use. It's a nightmare, quite frankly, dealing with lots of random trustee when I speak as a manager of a charity, because you need individual leases with them. But I think there is something for the social investors on the call to kind of think about. And I think it's this, that, funders like Lottery are looking at putting money in for solar panels, and obviously Teesside have borrowed money. That's great. But obviously the grant funding that's out there is limited. For those community buildings, I think it needs to be a combination of grant funding alongside probably things like community energy co-ops like Wolverton, but that in effect sort of subsidizes the install. It enables co-ops to go out and raise money on sites which are marginal and are a lot of work to actually get through. And I think we also need to think about maximizing the roof space, and that means talking to the grid. And again, energy co-ops are set up to do that, because there's certain limits that you can have on solar installs within grid standard processes. But actually, when we're looking at any site, we always apply to the grid, because the cost of scaffolding is so high. It really makes a lot of sense to maximize that roof space. Even if the site isn't actually using it all, they can export to the grid, which greens up all of our energy supply. The other thing just to flag up, I think, is around solar panels generally. There's a really good blog on Big Solar Co-op around the sort of ethical issues of solar panels, both the carbon intensity required to make them. We don't use any Chinese domicile companies now for solar panels. We buy REC, which is made in Malaysia. You can read the reasons why on the Big Solar Co-op blog, so it sets out it very well. And just around slave labour as well. There's been some pretty conclusive research around the use of Uyghur population to make solar panels, and that just needs to be part of the consideration. And it's certainly an issue if I see grant funding going into solar panels, and COPSI or community building is going to go for the cheapest ones. You can almost pretty much guarantee they're Chinese, and that people aren't sufficiently aware of some of those broader issues. I think. Just in terms of the kind of people that have invested in our solar co-op and the wind farm, it's quite interesting. Obviously, individuals, range of reasons, but some of the people that have invested, like Friends Provident Foundation, put in 100,000 because it complied, obviously suited their sort of investment profile. They then worked with an investment vehicle called Snowball, who then managed their fund. Wales Co-op Centre, who are now known as Compass, invested. Environmental Justice Foundation, and then also interestingly, the Ogwen, which is a community energy hydro scheme up in North Wales. They're not specialists in solar, but they put in 50,000 into Egni Co-op, and all those relationships kind of like help bond the overall sector together. I'd like to see, I suppose, more business investment in renewable energy co-ops to help make those links. At the moment, they can't, achieve some of their carbon savings, not carbon savings, but carbon targets. The tools aren't set up, I don't think, to enable. If they invest in a renewable energy co-op, they can't claim those carbon credits in a regulatory way for their carbon emission targets, and that would be really good to see changed. I think. Some of the, it was very interesting. I think one of the areas of growth in Wales is around shared ownership, which is limited in England. So we're working on a huge wind farm, 100 megawatts near Port Talbot. So we've got a 20% stake with the voluntary sector, actually, Neath Port Talbot, CVS, and Bridgend Association for Voluntary Organisations, working jointly with ESB, which is an Irish utility, and Coriolis, who are their sort of development partner. Anyway, that's to secure a 20% stake on that wind farm. It's a revenue investment model, so we take in theory, a 20% share of the profit. I think again that's something for social investors to look at, that model. We've had some talks with Thrive Renewables and Triodos about it. Obviously, their concern is they can't take easy security on that project in the same way that they have with our wind farm. But they recognise that's a big model going forward in Wales, so they are looking to try and see how they can support it. Unfortunately, in England, it's not really happening because of lack of government support, basically, for onshore wind. But again, I think as an asset model, it's something really to think about. Honestly, the wind farm is so much easier to run than Egni Co-op. All those individual sites are a lot of work. But they did save, the sites, as Martin was saying, from Teesside, it has a significant energy saving for those sites. So we saved about £125,000 a year and about 1,000 tonnes of carbon emissions last year. And that's going to, probably increase by sort of 50% next year because of what the sites are paying in their on-site energy costs. Yeah, I think that's all I wanted to say. Thank you.
Okay, lovely. Thank you, Dan. You've given us lots of food for thought, and there was some really interesting stuff. I'm going to try and do a little bit of a recap while Olivia just brings all the panel together for me. I've not had any questions yet in the chat. Usually it only just takes a couple of seconds, one or two, to come forward, and then I'm going to end up with a flurry and can't get them all in time. But I'm hoping somebody will either type something or just show the virtual hand, or we've got one question here already, which is great. Okay, so you all just did such a fantastic job, and there's this piece at the end I'm going to come to, which is sort of our 7 lessons learned, which have come from lots of other here from peer speakers like you, and you've done so many of them already for me. But what I found fascinating, as you recounted your own business models, your own communities, and as we covered from a range of different business models, we also covered solar, wind, we covered efficiency, energy efficiency, we covered ground heat pumps, you know, we covered a whole range of the ways that energy resilience can be applied. The other thing that I thought was fascinating is that we've also talked about a range of different investments, so including equity and debt. And we talked about how the fact that sometimes, this is something people often say, that a relatively small amount of social investment can help to secure other amounts of grant as well, because it helps grant makers to think about, to understand you thought about the sustainability of your organisation. And we've gone from blended finance to large amounts of share capital to, and then to smaller amounts of loan. Excuse me, not where that came from. So you really covered a wide range, and that's always the aim of Let's Talk of Finance, is to show that social investment can be used in a range of ways. And the fact that, of course, you love your social investors, which is good. And I think it is important to say that we often get feedback around the fact that working with the social investor can feel quite corporate, quite like working with a bank. But we also know that so many of our Hear From peers do. And I think it was you, Jane, that said, you know, you get so much more than just the money. And so it was really great to hear you say that. And I know and love all of the investors as well. So I know that to be the case. Okay, so I have a question, the first question here, which is for Jane, Martin, and Dan. The question, how did you demonstrate the impact investment would have to your social investors? So just talk to us a bit about, everybody wants to talk about impact measurement, you know, and there definitely was a time, I think 7 or 8 years ago, every conference I ever went to told me they'd got the solution or the answer to how you measure social impact. We spend a lot of time talking to people about what's proportional, what's relevant, you know, numbers without stories, that you need to measure what you value. But could you just recount to us when you've been working with your individual investors? And I appreciate that's not just the social investors, it could be your investors, your the shareholders, it could be individual investors or people like Friends Provident, for example. How did you go about demonstrating what that impact would look like? Shall we go back to Jane first?
Sure. Well, what we were able to benefit, so a couple of things to say around that. First is that what we were definitely able to benefit from was that when we ran our community share offer, it was in a sort of time when there were lots of community energy societies raising funds and around the same time. And the early ones, as Dan was very early, but lots of them had started up around 2010-ish. So there was a track record there, not for us specifically, but for the community energy model. And a lot of our investors are multi-investors. You know, they didn't just invest in us; they also invested across the country and other renewable energy opportunities. So we benefited from a track record in our business model, behind our business model, and also the fact that there are lots of individual investors who want to find proper ethical investment. And then the third angle of that was local investors, and we already had a track record with them in a way, because obviously of the work that we'd already been doing locally. And then we then talked about the first people we had signed up to come on board with their roofs and what they were about. So I think that was what was so powerful about it.
Okay, fantastic, thank you. I'll ask Martin the same question, and we've got some more questions coming through. So this is what always happens. You only have to get one, and then they all start to flood through. So let me ask Martin that same question, and then I'll perhaps go back to, we've got some questions about community shares.
Thank you, Melanie. Was the question, how do we measure social benefit? Is that what you were asking?
Yeah, what we say is that social investors want to know the difference their money is going to make. Right, and then often people think, oh, well, that means I've got to do like a social return on investment metric. Yeah. But we hear from social investors actually there's a range of ways that you can do that. So how did you communicate to Brian, you know, what difference the money that Keep On Going to make?
I do remember this because it was really complicated and difficult for us. When it comes to measuring social benefit, those that run a community building don't do anything really exciting. We kind of the facilitator of the social provision. We create the right environment for others to do the wonderful work. So I remember struggling to come up with some type of measure, because if we're providing a facility where someone is doing kung fu for children and he wouldn't have been able to do that without us, well, we definitely provided a social benefit, but he was the guy doing all the work, and it's the groups that do all the good stuff in our buildings that provide the measure. So what we started to do is we agreed that we measure the number of community groups, and that's increased massively in our building since we took it on, and I think we've gone from, there was 12 groups when we first took the building on, and we counted 36 this week, and they're doing so many wonderful things. But it's a bit of a crass measure, you know, because it's not really social benefit that we're delivering, it's others that are delivering it. And we agreed a matrix around that, around the number of groups, service and activities that the local people can benefit from as a consequence of. Oh, sorry, yeah, sorry, my colleagues, she's here to serve me, and she's just done it again. We developed a tool that we nicked off Sport England, like a footfall matrix, and so we measure the footfall of our building as well. So, if, for example, if judo meets twice a week and they've got an average, 12 kids coming to each session, we times that by 52 and say, well, that's the footfall for that group per year. And we're able to say these grand figures like, hey, 160,000 people, there was 160,000 visits to our building this year. And that sounds quite profound, because it's a big message that what we're doing works, it's popular, and people want to come and use attend the activities that are delivered from our building. It's difficult how that links to kind of solar panels and money and finance, but every penny we get, we invest in making the building better, improving the environment, making it cheaper and easier to use, in every way we possibly can.
And I think I love the fact that you said it is exciting. To me, Kung Fu for Children is exciting, and whatever, and that's where I think this point comes about measuring what you value. So not being driven. I remember someone said to me, I've been asked to measure this. And I said, have you asked why you've been asked to measure? That's actually about grant, actually. And they said, no, I just thought I had to. Well, I don't think any social investor, unless going to correct me, is going to say, you need to fundamentally measure this, okay? Yeah. What they want to know is, how is their money going to make a difference? You being able to articulate that is really important. Thank you, Martin. And I love that. If you want to put, I think we're always up for sharing resources and tips and tools about how you do that. So I'll have a look at that Sport England football tracker. I'm going to come. There's another question here about community shares. And Dan, you talked a bit about this. The question is particularly, I think, for Jane, but Dan, feel free to chip in as well. And so the question is around how easy or not was it to do that raising investment with the vehicle. Now, I know you used a platform, you used FX, which some people will use platform to do their fundraising. Some people will work with people like the Community Shares Unit or Cooperative UK. There's a whole range, and there are, like the lady from the BBC, there are other platforms that are available. So there are different sources to do that. So the question was, can you tell us a bit more about how you went about doing this, how you found raising, how you found it? Was it easy using that vehicle? And then I suppose that the main thing was, were there any additional benefits of doing that further down the line?
Yeah. Shall I kick off, and Dan, I'm sure you've got time. So for us, bear in mind at the time we were starting up, so we had no existing assets at all. What we had to do was gather the proof that we were going to have some. So that was about, so the first thing you have to do is make sure that if you're raising money, it's like raising money from anyone else. So we're going to be paying back people their capital and their interest of the money they were investing in community shares. So we wanted to make sure we knew we were going to be able to put some solar on some various rooftops, and we were also going to be able to commit, someone was going to pay us for that energy. So those two legal documents I mentioned in my presentation, the PPAs and the leases, are fundamental. They're our assets, actually. They are our real assets. So the first thing is you have to persuade people that they're going to sign up with you. And that can be much harder than you believe. I'm hearing it's not so hard in Wales, and maybe it's us, but you can find the perfect building, but 5 months later you realize you're on the 7th ownership person. It turns out to be a pension trust, and they really are not very interested, because there's absolutely no benefit to them to put solar on that roof. So you can have an awful lot of time trying to find appropriate rooftops. Anyway, so that's finding what you're actually going to get the assets, where your assets are going to come from. The process itself is tried and tested. So then you have to put together a document, your presentation, in effect. You'll share off a document that says, this is who we are, this is what we're going to do, this is how we're going to make some money, this is how we're going to pay you back, and over what kind of time period. And that, once you've got your story, that's relatively simple. And then if you do work with an ethics or any of the others that are out there, then they are hugely professional now. And they are able to help you with the writing of those documents, but also they put a number of other things in place over the years. So one of the real pains in the neck is, for a small, very tiny business like ours, is, how do you pay out every year that capital and interest on the shares? Well, actually, we use a share registry service that Ethics offers. And it works extraordinarily well. It takes out all of the pain. We pay for it, but it takes out a lot of the pain. So that's one huge benefit. A second benefit is that they obviously have a machine behind them to help you raise those funds. And that machine is a lot around the fact that they have all those email addresses and contact numbers of all of those ethical investors across the UK who are interested in projects like yours. So it's a vast database of potential investment. And the third thing that they also do is they now have also built a network of obviously other people who are interested in the area, so they can top up your investment your share investment and match fund, and whatever they've got available at the time depends on where you tap into it. But I would say so I would say the process is tried and trusted. You need to get together the assets, what kind of business you're going to have, and build your story, and they help you manage that initially and over time. So I hope that answers the question. But
yeah, thank you. And the pros and cons definitely are that, if you're using a platform, then obviously they're a business, so they need to charge a fee, and you pay for some of that, but then you get back some of that. But that's definitely a decision you have to make. So bearing in mind that community shares can be used for community land trusts to build homes, for village shops, for pubs. There's a whole range. Some people choose to do it themselves, some people choose to work with a platform that may have some relevance to how it's.
There was one thing I didn't say, and Dan mentioned it in his first presentation, actually, which is really important, is also it is, so when you get a social investment loan, you have to pay back every month the same amount of money, come hell or high water. A community investment, a share interest, each year the board makes a decision as to what interest rate you pay on those shares and the capital that you pay back. So it gives you a lot more flexibility.
Definitely the most patient form of capital. Dan, is it really easier in Wales? You want to know? Because we're all going to be moving.
Yeah, no, I think I suppose what was easier was actually working in the public sector once we got through procurement, because the council owned all of the schools, all the public buildings. So where Jane was talking about, trying to get individual sites, we were able to work, especially with Newport Council, to basically develop about 2 megawatts of rooftop solar on about 25 buildings, which, it just made life so much easier. Yeah, so it's different. In England, you've got multi-academy trusts and stuff like that. Yeah, so I just wanted to say that we haven't used FX. I suppose part of our motivation is kind of job creation. So we kind of always go into things thinking, why don't we, can we just do this ourselves rather than paying, ethics are great, but, they're based in Oxford. They don't speak Welsh. So we're kind of wanting to create jobs locally. And also, right, it is incredibly exciting doing your own share offer. God, you get all these checks and stuff like that through the post, bank transfers. Sometimes people literally just drop money in through our letterbox. It's like amazing. So
I think it's fair to say, just for sort of nationwide context, that the both the Welsh and the Scottish government approach to community energy and to climate initiatives is quite different to how it is in England. So there's definitively different, and I think that's probably reflected down in your comments around the procurement piece and sort of some of the initiatives. I'm not sure it's easy. Right, I am really conscious of time. I've got a couple more questions, but I'm just going to finish with one, if it's okay, because I'm just thinking about and finish on time. And this is one for you, Martin, from Chloe. Said, I think you can get the point about, and actually, Danny, you made reference as well to trustees over here. So, Chloe sort of was really interested in the story, Martin, but were there any doubts or fears, where the money came from and how your organisation got past that? Because often we hear trustees can be, very risk averse. People are really worried about whether taking on debt is the right thing to do. And I know you've got the lovely Lynn, in fact, just to your right. She's the best drug, which everybody needs a lovely Lynn, I think. But did you have any of that?
You can answer that.
Maybe I ask you that question. How do you overcome some of those barriers or fears?
Well, it's interesting. I saw. Thank you for the question, Chloe. I came up and I whispered in my colleague's ear, about that, because it's quite a while ago we were looking at this, and she had the perfect answer. Our fear was not about doing it; it was the consequences of not doing it. You were petrified about what might happen unless we could do something around this energy. And I imagine most organisations had them fears at that time as well. Like, what on earth's going to happen? Where's this going to end? What will the impact be on us if we don't act now? So inaction was our biggest fear, not action. And any fears that we had to navigate as a consequence of taking the decision to move forward with it were small in comparison with the fears of doing nothing. I suppose, Chloe, that's our answer to that question.
Lovely, thank you. Dan, Jane, anything else to add to that?
I think, Dan? Yeah. So our experience is really that community groups, but also businesses, are just hard work, and risk averse, etc. And I think Jane said, if they've got a mortgage on their building, that makes life complicated. We worked with a religious organisation who run schools, the Archdiocese, and when we got into the detail of their lease, of their ownership, literally half the sports centre was owned by the Knights Templar, and the other half was owned by God, or something like that. We just had to take a view that neither of those two parties, if they still exist, were ever going to pull down that sports centre and therefore destroy our solar panels. So yeah, the legal stuff is quite tricky, but I just think I've tried to mention in my presentation, the combination of grant and working with community energy is something to think about going forward. Cheeside, it's brilliant what they've done there, getting that loan, but that's quite challenging for a lot of community buildings, I think. And also, I would also say that I've seen a lot of solar panels that aren't working, and that's because it's not anyone's job description, particularly to monitor if they are. And whereas like energy co-ops, they have to, because it's in their 20-year, 25-year business plan. They've got to make sure the output is actually running all the time. Teesside obviously are, because they're checking their meters every week. But there's energy co-ops out there that can do all of that stuff online to make on an individual panel level as well, to make sure that they're getting the maximum output. So I think there's a natural affinity there that we could take further. And this is across the UK, not just in Wales.
Lovely, thank you. Sorry, I'm going to squeeze this one last question in. So I'm going to just put the question out there, and then you can jump in and just tell me. And then I'm just going to come back and ask you, I'm giving you advance notices of just like one top tip, anything that you would share with anybody that's listening here who are thinking about the energy resilience of their social enterprise or charity and what your tip would be. But the question, while you're just thinking that through, is did you get any other business support? I think a couple of you have actually sort of referred to this, but as well as taking the investment, is there anything else that you got from your social investor as sort of part of the package? Jane, do you want to go?
So yes, without question. It was more about sort of other ways in which we could get new finance into the business than how to run our business, if you know what I mean, but very important. Yeah.
Fantastic. Finance and sort of funding. Yeah. Dan, Martin?
I'll jump in. We learned a lot from Triodos Bank actually on the sort of wind farm, especially which is called non-recourse, debt finance. But basically, they're just lending on the basis of the wind. So, they went. We had lawyers on both sides. We worked with Burgess Salmon in Bristol, who were brilliant actually. They worked with TLT, but literally scrutiny of every single document. The wind reports, the lease arrangements. The power purchase arrangements. It was just so rigorous, and it just made me. I learned a lot, going through that process. And Alan was kind of there to help me get my head around it in a kind of informal way, because I didn't want to sound stupid, which could have easily happened. But anyway, it was very useful process.
Thank you, Martin.
Yeah, thank you. I don't want to inflate Brian's ego there because he's in the audience, but Brian worked with my colleague Lynn quite a lot, and he was incredible in terms of the support he provided. We rehashed our business plan. He scrutinised it, fed back comments. We updated it, and that helped us actually as well to be a bit more streamlined and focused in the way that we present ourselves to outside agencies and organisations. I don't know, Brian, you're there publicly. Let me thank you. You've been fantastically supportive of us, and Lynn says that too. So thank you for everything you've done for us.
I have to thank you as well. God, I have to thank him as well, because I managed to broker him into doing a trustee with me. So we all know that this is pretty good. He doesn't know me. I normally wrote him in for something. So just a couple of weeks ago, we were talking about the challenges of refinancing actually, and Brian was giving me a little bit of education on the basis of some of the deals that he sees. So it is really nice to hear that, and I'll make sure I reflect it to all of the organisations that you've received investment more. Not just because as an action retailer, we tend to get lots more complaints than you do thanks, but also just to sort of bust that myth that every social investor that you meet is what's the word that was in a Pioneer's post, too many fancy pants bankers. So not everybody is like that. And I tend to say that people who work in the sector, they also care equally about the impact, and that's what unites us and all here together. I usually say this and then say, don't tell my employer, but there's loads of big side accounts people on the things. No good saying that, which is basically, I don't actually care about social investment. Like, social investment's not my world. It's the impact that the social enterprises and charities create. I just see social investment as one of the ways to help them scale and improve that. So I just wanted to say thank you, as always, Dan, Martin and Jane. You did not disappoint. You saved me from having to talk all afternoon. Your stories were amazing, and you brought so much of how energy resilience, which, to your point, Martin, might not sound like the most interesting or exciting thing, but it's definitely one of the most important things in terms of making our business model sustainable. So thank you so much for sharing your stories. We're just going to try and wrap up now, if that's okay, with a few case studies. And I'm going to come back to those 7 lessons learned, which lots of other here from the peers have shared. I've done most of them for you, so you've done my job in this. But thanks for your time. It's been invaluable. Okay, so we've got around 15 minutes left. I'm just going to run through a few more case studies, so some other examples of organisations that have done similar things. And you can check out in these 4 case studies. I think we've got a podcast if you want to listen as well, so you can find out some more information. I usually say, if you're thinking about this from a social enterprise or charity perspective, there's usually somebody that might have done this before, and both social investors and social entrepreneurs are very generous with their time and their peer experience. So please do get in touch, and we'll be happy to share these with you or try and make some connections if we can. So the first one is a Southmead Development Trust, essentially running a youth and community centre. I suppose very similar to the Tees Valley story. Their turnover was 1.41 million. I think it's interesting here, this is quite big turnover, but please don't feel that you have to turn over a lot of money to take social investment, because that is not the case, and certainly not the case any longer. And they took on £50,000, again, a secured loan. So we've talked a bit about securing assets. Here they had something that the investor was able to secure against, and that does tend to lower the risk and lower the cost of finance. And here you can see it was around one of the older cases, actually. I think it was back to about 2011. was installing solar panels on their own space. We've got Brighton Hove Community Energy Services Cooperative. I put this one up particularly. They had investment from Camp Venture Firm, which was actually interest-free loan. Lovely if you can get interest-free loan. Not lots of these around, but Camp actually has some specific programs both in the Brighton area and in Wales. But what Brighton and Hove actually do is they do some of the services that the other case studies have talked about today. But one of their main business things is actually in energy advice and energy assessment. So then you can actually look at, after you've paid them for that or got a grant for that, that you can go on and then look at taking investment to actually do the recommendations based on the grant. So they had a £30,000 interest-free loan, but they also raised money through community shares. And again, not unusual to find multiple forms of finance, particularly in some of the larger schemes, or blended finance, combining grant and loan, also having other forms of finance funding like Jane talked about. So there's a podcast for that if you want to, from Let's Talk with Finance, actually. So to be HESCO, then you can listen to their story. And here we've got Ambition Community Energy. So this is wind. Again, this was about £750,000 raised. This also had some match money from Power to Change in it. And this has got both unsecured and secured loan in it. So probably it will have secured loan, again, slightly lower cost of capital, and they probably have unsecured loan, slightly higher cost of capital. Again, you can see the full case study there, if that's helpful. There are many more of these. You've got some social investors on the call, so they may have some more case studies they want to pop into the chat. And the Energy Resilience Fund is something that we're delighted that through the dormant assets consultation, a further £8 million has been committed to scale that fund. So hopefully there will be more of that type of investment coming forward. Okay. So this brings us to our 7 lessons learned. Really important for me to say, these aren't my lessons. These are lessons from many more Janes and Dans and other Hear From A Peers that have spoken today. We've done around 60 plus of these Let's Talk with Finance, and these are the 7 lessons that they tend to say. Don't forget, I'm going to come back to you, panel, for your top tip. So, number 1, social investment is not benevolent money. Do you remember that elephant I said we should get out on the table very early? Unless you are with 0% interest, even then you're going to have to repay the capital. You tend to need to have to pay the capital plus interest. So you'll need to have a firm business plan. It doesn't mean to say that it's all expected to go to plan, and we're going to talk about what happens when it doesn't. Impact matters. So that last but one question we asked about, how are you going to convey the impact, the difference that money is going to make? There are things like our outcomes matrix, which has had over 90,000 downloads and can help organisations to think about what they want to measure and how to get started. It's not a measurement tool in itself, but it's certainly, I've used it in one of my trustee roles just to think about of all the things that we did, what would we actually value measuring? But telling your story is really important. As a fantastic example from an organisation, a community interest company based in Liverpool, that told me how they managed to negotiate with all of their funders, social investors and grant funders, that you produce one impact report that was important to them as a project, and that's the way they conveyed that to them, to do lots of impact reports for lots of different people in lots of different ways. Feel free to challenge and take your suggestions. Don't always feel that you've got to be the passive recipient at the other end. It's about much more than the money. I don't think I need to say lots more than this here. The speakers did this so well today. You do need to find the right investor. So go back to my original presentation about what social investment is and isn't. Not all social investors lend the same kind of money, so it's important to try and find the one that's the best match for you. I have a lovely quote from a social enterprise in Birmingham who said, had to kiss an awful lot of social investment frogs before they found their social investment prince. I think what they were trying to say was that you're in a long-term relationship. When you borrow money from a social investor, probably the least amount of time that you borrow is 3 years, but in some of the cases we've talked here, that could be 7, 10, 15 years. So finding somebody who shares your values, that you can have a relationship with, that you can to is really important. I know that there's a charity bank investment manager that long after the loan was repaid, a social entrepreneur, a charity leader was telling me that, you know, whenever he had an enterprising idea, the first thing he did was picked up the phone to the investment manager and had a chat with him even before he thought about actually applying to borrow money. If honesty is always the best policy, what happens when things go not according to plan? I asked this question at the last Let's Talk Good Finance of all the social investors, and how many of the deals that they write and the business plans that they see are going according to plan, and they said about 20%. So they're quite used to things going wrong. Any of us were prepared for COVID and then for the cost of living crisis, but you know, I know that all social investors were available on the phone. What we say is, if things aren't going according to plan, if even within the stress testing that's done as part of due diligence, when we're going to get to, you are worried about making a repayment, do not stick your head in the sand. Pick up the phone and talk to a social investor. They can't help you unless they know what the problems are, and avoiding them is really not the way to go. I've heard this so many times. I've even heard from one investor that they're on about their 21st loan amendment, having to change the way that things have been done. I have known investors to give capital repayment, interest repayment holidays. I've known people to think about refinancing, even refinancing to other organisations. So there's a whole range of things that can happen when things don't go according to plan. So call your social investor. Number 6, due diligence isn't fun, but it does make your business better. I've only found 2 people that actually enjoyed it. They're both based in Nottingham. I'm not sure about what that says about the East Midlands, but most people don't find it fun. Most people need to have somebody alongside them, particularly if you have got somebody like Glyn that's involved in your finances. But it is important also not to delegate it just to somebody else and not understand. Certainly from the trustees and the executive team need to understand their management information. Even when sometimes organisations haven't gone on to be awarded investments, it's not gone through panel, they still think that their business is better as a result of understanding due diligence. Now, due diligence is something we get asked a lot of questions about, and actually it's the subject of a new deep dive module as part of our social investment unpicked. It's a free e-learning course that we're going to be launching pretty soon. So due diligence, so you can understand the sorts of questions that are asked and how to prepare for them. I think there's a lot of, again, myths, because many people don't have a chance to experience what due diligence looks like until the first time they have to go through it. And we definitely know that once you've done it, people tend to get confident and go on and feel confident to do it again. And then last but by no means least, it always takes longer than you think. Again, this came up a lot in the event I was in yesterday, just about being really honest about when your panels meet. What's the average time for a decision? Not what's the best time, what's the optimum time? It could happen in 6 weeks. If the average is, it will probably take 8 to 12. If even when you've gone through panel and been awarded, it's going to take another 8 weeks to do legal, it's really important that you share that with the investees, so that everybody is surprised and can make and do their plans. And last but by no means least, we usually say, don't leave it till you need the money, because generally social investment doesn't work at its best when your back is against the wall. Although I think we still did some of our best work during COVID. But generally, the longer you have to try and find the right investment, the right type of money, the better the results for your organisation. So I'm going to come back to my speakers. One top tip, I'm going to start with Martin. What's the one top tip that you would recommend anybody thinking about exploring social investment for energy resilience? What would you say to them, Martin?
Well, I haven't got one. I would just be bold, you know. I in that slideshow, I had to be bold and try it. It's you might have gathered that I'm not a finance person. My colleague Lynn is, but sometimes you've got to embrace new things sometimes, and it has been a good move for us. So that would be my advice. Be bold, look at it. You know, don't be fearful of it. Because a lot of people are fearful around money, and especially when it comes to loans, you worry about your ability to pay things back. Even if things are going good now, you tell yourself, oh, what might happen in 2 years or 3 years? But we have got a good business model. We've got a great bunch of trustees, and with the support of the Key Fund and Brian, you know, it's filled me full of confidence. So be bold, my tip.
Be bold. Think about and weigh the risks, but be bold. Yeah. Okay. Great. Dan, what's your top tip?
Yeah, I think momentum is key. You know, I remember and take risks. when we built our wind farm, literally, we did not have all of the agreements in place to complete it, but we used members' money to start building the track.
Okay.
And from that, we again got investment. Equally with Egni, we were in the middle of COVID. We were in the middle of installing a huge 500 kilowatt site on the velodrome, and then COVID happened and we had to take all of the scaffolding back down. Luckily, the government extended the feed-in tariff deadline. Yeah, so it's kind of momentum.
Okay, momentum, there's definitely some vision in there, I think, about having that long-term strategy and plan. Jane, what's your top tip?
I suppose celebrate when it goes well, because it's a long haul and sometimes it's really difficult, and actually, you know, take the joy when it's there is what I would say, and keep going.
Lovely, love that. Be bold, make sure you got momentum, you keep it going, and celebrate at the end of it. Thank you so much. You've been a brilliant panel. Thank you, making my job really, really easy. Right, we're almost out of time. I'm going to hand it back over to Chris from Social Enterprise UK, who's going to talk a little bit about membership. And from my perspective, it's been a joy to host this afternoon. I'm so glad we recorded it. I'm sure there's lots more we can do with these here. If you need to get hold of Olivia or myself, if you have questions that we didn't answer today, then we'll be sure to share our details so you can follow up. So, but last but not least, over to you, Chris.
Thanks, Mal, and thank you very much for such an incredible session. I just want to quickly come in at the end and just mention that we have recently at SUK launched a brand new online members area that has a massive resource section, which includes obviously all the tips and tools that Mel shared earlier from Good Finance and other stuff on social investment as well. It also gives you really good access to the online member community where you'll be able to ask questions. So if you have any questions about social investment going forwards, put it there, and there will be people who have sort of experienced the same thing as you, and you'll have that access. So really valuable. If you're not a member of SUK, please do email us. I put the email in the chat at the beginning, and we'll share that around later as well, so you can get in touch and talk to us about membership. So that's it from me. I'll keep it short and sweet.
I've just got one thing I've got to do. Otherwise, Olivia will be virtually kicking me under the table, which is that we have a little feedback